fourth MPC press briefing. It's the second MPC for the year, but the fourth in the series of MPC briefings. The deputy governors, directors, Bank of Zambia, fellow colleagues from Bank of Zambia. I should have actually started with the committee because they are the ones who have empowered me to speak here. So fellow committee members of the Monetary Policy Committee, members of the press, ladies and gentlemen. The outline for today's presentation is as displayed on the screen. I'll start out as always with the decision of the committee, followed by some information on inflation outturn and how we view inflation going forward. Then we look at the foreign exchange market because of its intricate relationship to the subject of discussion. Then we look at credit developments, economic activity will follow, and I'll then present a conclusion. The committee at its meeting of Monday and Tuesday, yesterday, decided to raise the policy rate by 100 basis points to 13.5%. This was informed by a number of factors. Even at 13.5%, you note that it's still below the inflation, which is around 13.8%. So calibrating it to that level was a subject of intense discussion and the poring over information to see how best we could move forward. What the committee noted was that inflation has continued to move away from the target band of 6 to 8%, which is what is given to us as the target to aim for. We also noted that there is a persistent rise in inflation expectations, which, if left unchecked, are poised to undermine macroeconomic stability and efforts towards robust and sustained economic growth. Now, we say expectations. What we observe onshore and offshore is that players think that inflation will continue to rise. So we have to arrest that kind of expectation because it tends to self-fulfill if left unchecked. We made projections too of inflation over the next 2 years, that's 8 quarters, and that projection indicated that inflation will average 13.7% in 2024, and then which in effect is higher than what it was when we last met here in February. Now, this decision should not be taken in isolation. It's taken as a complement or a supplement to earlier decisions or actions that we as a monetary authority, along with the fiscal authorities, have been implementing. So everything that we do is connected, so you might say. Now, what we observed is that inflation is currently very much driven by what is happening in the exchange rate market. It's also driven by what is happening in the food sector, especially maize grain. In this presentation today, we'll try to show more granularity in how the basket that we are looking at is made up. Now, when we look at the outturn of inflation, we see that it has risen to 13.5% in the first quarter of 2024 from 12.9% as indicated in 2023. In April, which is after the quarter's end, inflation increased further to 13.8% from the end March position of 13.7%. Now, let me just turn to the table. As always, this table is in two parts. There is the upper part and the lower part. So what I would ask you to look at closely is firstly the first part, which is the upper part, which talks of average inflation. So if you look at the second row, which talks of overall inflation, you note that inflation has actually been rising since Q1 2023. Now, when we look at the subcomponents of that overall inflation, which is food and non-food, you see that the food has persistently been rising as well from over the same period. For non-food, there was a bit of a break, but it's also showing an upward trend. Now, if you look at the bottom side part of the same slide, which we talks of end period inflation, we see a similar kind of story being told. It shouldn't be different anyway because the other part is derived from this, but sometimes there can be differences. The average can deviate from the individual end period numbers. So, but what we are saying here is that inflation has been rising. So in our decision-making process, this is one of the key factors we look at, and then look at what will be the outturn for inflation over the next 8 quarters. And then we look at what risks underlie that projection. So from outcomes, inflation is showing an upward trajectory. Now, what are the factors that underlie this? As I indicated, the currency is a major factor. Rising prices of food, maize grain, maize products, and vegetables, and energy, fuel here in terms of the pump prices that we see. So these are the main drivers we see. Now, vegetables, usually around this time of the year, we should have more vegetables. But I think we have noted over in the recent past that this is not happening anymore because we seem to be using every available piece of land to put buildings. So people are no longer growing backyard vegetables, which puts pressure on the supply that comes from elsewhere. So this is a new phenomena that we need to look at closely going forward. Now, I said look at the components more closely. Sorry, this is quite cluttered. You may not be able to read what it is showing. What we are trying to show here are the various components of inflation, the basket, the CPI basket. So on the left side of the screen, we have the contribution to overall inflation by product in the first quarter of 2024. In the second slide, there was chart, we are looking at the same phenomena, but this time over the month of April. So one is for the quarter as a whole, the other one is for April. I think when we meet in August, we'll be able to show the full quarter outturn. But for now, we are showing what it had been in April, which is the month of April. The longer bar on both sides is reflecting the prices of a breakfast meal. So you can see that is quite a dominant factor in the charts. The next bar on the quarter one, just below the first one there, that's roller maize meal price. But when we come to April, the second bar is not roller maize meal, it's overtaken by charcoal. And you can see the struggle which is there. One, in a bid to deal with the environmental issues, there is a ban on the use of charcoal, but that pushes the price up as now more people want it. So it's a trade-off that we always have to struggle with. The third bar is on the left one is maize grain, but on the right is where now we have roller maize meal. So at your own time, I think you go through this and appreciate what forms the basket that we are looking at. But of significance here is that much as we say that food may be purely a supply side issue, because sometimes people have raised questions as to why do we worry about food when this is just a supply side matter. We should be more concerned with the demand, because that's where our tools are best suited to address. Now, the point is that when you drill down to see some of those components, you see that they are imported items as well, which form part of the food basket. So when the exchange rate moves, they also move. So the issue of exchange rate, how it affects different aspects of the economy is quite wide. And that's why I think it is important to appreciate the need for that variable to be under control. But it's also influenced by a lot of factors, some of which may not be entirely under the control of the central bank, but influenced sometimes not even by the country, our country that is, but coming from external sources. So all we urge in this, why do we need foreign exchange? We need foreign exchange to import some of those things. Now, the question is, are we going to continue to import these things, or we can produce some of those, which is the import substitution, in which case we save some of that foreign exchange that we have to spend. So that gives you an idea, even at a personal level, perhaps where can you try to come in to do something. But the point is that it's not purely a supply side issue. There are aspects of the demand side through the exchange rate channel, as you will see later or as we talk in other variables. So I thought I should spend a bit of time on that one to explain that. Okay. Now, when we move on to the outlook for inflation, during our last MPC, we projected that the inflation will remain above the target. That's what our projection was saying. In fact, as you see shortly, it was actually above the target. This time around, what we see is that it's above the target for the most part of the forecast horizon, but as we move towards the end, it actually gets into the target range. Let me just show that immediately. So if you look on the chart on the screen here, the chart on the left, the yellow line or the orange line, bar, that's the target that we have. Clearly what you see, the heavy line, which is not dotted, is showing actual inflation. Where you see there now, we get two dotted lines. One which is red and the other, I think, green or blue, depending on your eyesight. If you are good at color schemes, you may see the green, but some of you like me may be seeing blue from this end. Anyway, the point is that if you look at the red, this is the projection we had when we last met in February. You can see that inflation was actually staying outside the target range throughout. Come this time, make a similar projection, which is now the other line. You see that it's elevated, it's higher than what inflation projection was the previous quarter, but it drops to the target range towards the end of the forecast horizon. Now, the issue we are dealing with now is this intervening period. If we don't do anything, this could actually move even further away. That's the issue that must be taken into mind. Because people might say, well, if it is coming down, why are you concerned about that? But the point is that there are so many risks that are at play here that if we don't address the inflation expectations that I referred to earlier, this may not actually come about. It could even move further up. So this is the trade-off that we have to do. It has also to be borne in mind that this action we take is short-term action, which we review every 3 quarters, every quarter when we meet. What do we do based on the evidence that we have before us and the projections that we make. So if, for example, we find that based on the actions that we are taking, we meet in August, this has moved closer to the target range, then we'll make a different decision. But where we are now, we see that it's way too elevated from our target band, and we cannot just let it be. More importantly, the driver is so pervasive, as I indicated, one of the drivers, that is the exchange rate. So the exchange rate will also affect the importation of food items that we are expected to do because of the drought that we are experiencing. So it comes in different forms. It will affect the budget as well, in that now you have to come up with more kwacha to buy the same dollar and import. So these are some of the things that we have to grapple with and try to strike a delicate balance on how you manage this. Each one of them obviously has got its own pluses and minuses, but inaction is not an option in our case. The table there is just putting in number terms what the charts are showing there. So if you want to see the numbers, look to the table. But if you want to see the graphical representation of the same, just look at the chart. Okay? Now, in the foreign exchange market, which I've talked about, we saw that in the first quarter of this year, the kwacha depreciated by 10.6%, slight moderation from what had been the case in the previous quarter. In the previous quarter, it had depreciated by 17.5%, but still a depreciation of 10.5% is quite significant in a quarter. Now, what we see as the driver of that depreciation is by and large the mismatch between supply and demand. Supply has not kept pace with the demand that is there in the market. Maybe next time we'll show you a chart which shows it's literally like mountains. When you look at the pipeline of demand that shows up sometimes, and then you see that translating into the kwacha moving. So the graph there is just showing you graphically how the kwacha has behaved against some of these major currencies. Now, let me just move a bit to supply has been now more or less been tied to what we get in terms of taxes, mineral royalty, and other mining taxes. So what we show on the right here is what has come through. You note that the bars are getting shorter, which means that the supply is reducing. Meanwhile, demand remains elevated. So that mismatch on and by itself does lead to a movement in the exchange rate. Now, to try and moderate the volatility that we see in the market, like I said last time, when you are seeing the rate that is posted is a rate which has benefited from some of the actions that we undertake. If you were to see the intraday dynamics that go on, you'll be really seeing that there is quite some movement that takes place. So, but reading that, we take action to moderate that fluctuation. We also note that there are commodities which are of an essential nature. For example, oil, fuel imports. If those are not facilitated, then you begin to see shortages of fuel. We also have to be alive to the fact that we don't produce all the medicines that we require. So those have to be imported. We still owe people money. Yes, there is debt restructuring, which we're talking about, but we have not stopped servicing our debt to the multilaterals. That's the only way they can also continue to support us. So all that requires the use of the foreign exchange that we have. So to help the market breathe, we provide some augmentation by way of putting back this into the market. But sometimes that is not sufficient, so we kind of get the projected amount from the reserves with a view that we are going to recoup from the next period. But as you have seen, this has persisted over a period of time, and that's what is giving concern to this rise in inflation and the exchange rate. So now, last week, some of you who have a keen eye may have seen that the kwacha regained some of its lost ground, in particular on Thursday afternoon. This continued into Friday, Monday to today. Now, what are the factors that have brought this about? I refer you to the point made at the beginning that this decision we are making here is in addition to the earlier decisions we made. So the earlier decisions are beginning to have an influence on the behavior of players. By tightening the kwacha availability, because what it is that at whatever level the exchange rate is, there is an exchange of two currencies, kwacha and the dollar. So our actions are kind of adjusting the availability of kwacha. So by tightening, as we are doing, we are making the kwacha less available. Now, what that translates is to moderate the demand that is in the market. Now, some of the players, they don't have money of their own. So they go to banks to borrow the money that they want to use to acquire whatever they want to acquire, because they have a proposition to the banks to make. Now, we have two sets of players here. They are what we call onshore, which include you and I, and we have other people who play in our market who we refer to as offshore players. All these are keenly looking at what is happening in our market. So what we observed last week is that because of the tightening of the kwacha, they could not easily raise the kwacha part. So they had therefore to bring in some dollars to meet their kwacha obligations. In so doing, they augmented the supply of foreign exchange in the market, and that helped to move the exchange rate in the direction that we have seen. We have seen too, from the expectation side, that players are very expectant of meetings like this. So they take positions based on what they think the decision of the MPC will be, and then make adjustments to their positioning as to how they play in the market. Another factor which came up, you may have seen, you are the media, that there is a solicitation document which was put out to the bondholders to close that restructuring negotiation on the bondholders. So that is giving the expectation that this matter will no longer be an issue. So that matter is still playing out, but once others said, okay, now looks like we are moving forward. So those combined have led to this development that we have observed. As people charged with the responsibility of looking at, seeing what we are seeing, we have to take advantage of that by consolidating that gain. It wouldn't be prudent on our part to just let that go without augmenting it. So part of the reason to raise the policy rate is to augment that process, because that's what people are expecting. This is going to be the case. Now, with appreciating of the exchange rate, we may see the moderation. As you have noted, you reported following the declaration of the national disaster and state of emergency, we are in need of food, significant amount of that, which we have to pay in foreign exchange and get kwacha to buy that foreign exchange. So that is another factor to take into account. So the point here we are trying to make on this slide is that, yes, we did support the market, but our reserves position still remains about where it was the previous quarter, at 3.9 months of import cover, which is in dollar terms 3.6 billion. Now, this sometimes you may see, just to preempt that going forward, that you may have a lower quantum of reserves, but the import cover may be high. You may wonder now, why is that? Well, the point is that what goes into determining the import cover is the prospective imports. So if there is an expectation that imports will come down, then that figure would be higher, the number. So what we are showing here is that we have $3.6 billion in gross reserves. Now, we also are sharing with you, because we have heard this question many times, that in the first quarter, the gold purchases amounted to 10.6 million. Now, if I may just explain a bit here, that sometimes people say, no, why don't you just buy gold, go and do that. It doesn't work like that. The gold that we have to buy has to be of a bullion standard. And by that means it must be monetary gold. So some of this gold which is circulating may not be of that standard. Now, if you buy that, which is called dore, you need to process it further, refine it further. So there are logistics involved in doing that. And nowadays, too, there is a keen eye on identifying the sources. I'm sure you have heard the notion of fair trade. This applies a lot in gold trading. People who are trading in that, they want to be assured that this gold was not from a source that used child labor, that used forced labor, that violates certain covenants. If that turns out to be the case, since you don't have your own refinery, these refineries will not take it. Because when you have it processed, it has to have a stamp where it is processed and where it is sourced. So if you can't satisfy that requirement, you end up with the gold which is not of monetary standard, and then it wouldn't count as part of your reserves. So I thought it's important to explain that, because sometimes people just say, no, go in this area, buy. We don't have a refinery. When we get that, we have to have it refined, and there are not many refineries around. Credit developments. What we see is that there is a slowdown in credit in the market, particularly credit to government, which is important in terms of crowding out, which we have been talking about. Now, we have had questions in the past where I said, well, isn't it self-defeating that you are raising policy rate and then expect this to happen? It's a trade-off. as we have said, if we don't address inflation, it affects other things more. Yeah. So it's a timing issue to some extent, that when we are doing what we are doing, the expectation is that there will be adjustments so that in the period ahead, we'll be able to have a stable financial system so that interest rates can begin to come down. So they'll start out by going up, but once other things settle, you should come, if inflation comes down, you should be able to get interest rates which are lower. But if inflation is going up, you rest assured banks will be moving their rates up because they don't know where the things will land. So it will be like perpetual chasing a rising interest rate. That's why we are concerned about inflation, because with inflation down and at stable level, then you can have interest rates that are reasonable and affordable. So I thought it is important for us to stress that. Economic activity. This, unfortunately, is another very difficult year. What we have observed, earlier projections of growth for the year were quite encouraging. But here comes drought, which is affecting agriculture production, notably food. It's affecting electricity generation. So that has resulted in the revision downwards of the growth projection. So now we are seeing growth being projected at 2.3% from 4.4% last time. So this is what the chart on the right is trying to do. There are different groups that are making those projections. You can see that they are all showing that it's not going up, but it's coming down somewhat. So this is the challenge, another challenge we have in the economy to get growth. Then again, you may say, well, what you are doing, isn't that going to hurt growth? Yes, in the short term, there is that expectation. But again, if we don't address that, then it means the macroeconomic environment will not be stable and the growth will be affected negatively in the period ahead. Most importantly, too, you find that if we don't deal with this, we'll find that investments in productive lines in our economy will not be undertaken to the extent you would have expected to be, because everybody will be looking for that type of business which gives quick returns. But to get the economy growing at a sustainable level, we need areas of production which are of a longer term nature. So these are the trade-offs that we have to strike as we try to navigate the economy forward. Conclusion. So once again, the committee decided to raise the policy rate by 100 basis points to 13.5. It's still below the level of inflation. So others who are thinking we are not bullish enough will still come and say, no, you didn't do much. But we did what we did, taking into account the other implications of this action. So we had to strike a balance on bringing inflation down, getting the exchange rate under control, but not to the extent that once we increased by a huge margin at the same time, we then have other problems to deal with. So while solving one problem, we create a larger problem that we can solve. So having done what we have done, the expectation is that other players, structural reforms, structural measures have to kick in to drive the other desirable changes that we need to have in the economy. So this is one tool. It can't do all the things. We need a combination of measures, fiscal, monetary, exchange rate policy, structural generally, to really address all the different challenges that our economy is facing. So from our end as a monetary authority, we, given the mandate that we are given of price and financial system stability, this we think is what our contribution can be at this point. We remain vigilant to see what is going on and stand ready to make adjustments as circumstances permit. So for now, this is what we have done, and we believe that it will help in arresting some of the pressures that we are experiencing in the economy. And once those are reduced, they should spur other activities in the economy.